This is why universal life insurance is crap, is the title of a Dave Ramsey video where he and his co-host George Kimmel attempts to show the disaster of IUL and why it's so horrible. Let's take a look.
Here's how it's marketed. They go, you know it, you're supposed to use your life insurance while you're alive. Did you know that? And everyone's like, oh my gosh, this is brilliant.
Yeah, George is kind of right on this. There is a lot of advertisements out there. Oh, you're supposed to use it while you're alive, right? And they definitely have a get-rich-quick feel to them. These types of like Instagram posts and TikToks or whatever that aren't very informative, but just kind of talk about how much money they make or whatever, typically are something that I can understand why people are afraid of, and rightly should be. I definitely would not get an IUL from someone who at least isn't sophisticated enough to kind of break down the numbers and really understand from the core what's going on. I have plenty of videos going over like questions that you need to ask your agent before actually getting one, but I understand what George is saying here. There's definitely some advertisements out there that worry me, just as there's advertisements for financial advisors, for example.
All life insurance gets more expensive every year that you're alive, period, because you're statistically more likely to die every year you're alive.
Yeah, so Dave clearly is not wrong about this in the sense that life insurance or your cost per 1,000 of insurance goes up as you get older. Of course, the older you get, the more likely you are to die, so your cost per $1,000 of insurance is going to go up. The thing is with universal life, and I think he makes the mistake here in a second, I'm not 100% sure, we'll see. With universal life, yes, your cost per 1,000 goes up, but since your cash value goes up and gets closer to your death benefit, the amount of insurance you're actually paying for becomes less and less over time. So even though the cost per 1,000 goes up, you're actually going to end up paying less for the total amount of insurance as the policy continues to grow.
Okay. Now, the index universal goes up every year inside the policy, but you don't see it.
Yeah, I think he's kind of confusing whole life and universal life here. I'm not 100% sure, but he says you don't see it. You don't see that it goes up. IULs are completely transparent. You can run they don't do it initially. You need to make, your agent should know this if you're getting one, but you can run not only an annual cost summary, but also an internal rate of return report at the end of your illustrations. So if someone is running an illustration to look at an IUL, they should have those two actually already ran, and then they should go through that with you. So you can see your fees. It shows you exactly year by year what your fees are in terms of cost of insurance, your policy expenses, commissions, for example. All of that's in there. Like for example, let's go ahead and just pop up right here. This is an example of a policy I was playing with earlier today, but you can see here all of the different expenses. Super transparent, shows each year and where they're coming from.
So if you keep the stupid thing long enough, it will begin to be the point that the premium you're paying will not even cover the insurance cost.
Oof.
And so it starts to eat back into your savings just to keep the policy alive.
Yeah, this would not happen if your policy is structured correctly. So for example, if you wanted to move over $500,000 or $1 million into a policy, let's just say it's $500,000, let's say you had a death benefit of 1 to 1.2 million, right? And once you've funded that full $500,000, your death benefit is still the same, right? So we just keep it level. Well, as that $500,000 grows, well, what happens? The 1.2 million stays there. It's not gonna, because again, as our cash value grows, we're paying for less insurance because the gap between our cash value and insurance is more. So the insurance doesn't raise. So since that cash value is continuing to get closer to the death benefit, even though you're not paying any premiums anymore, a portion of that or a percentage each year goes towards the actual cost of that insurance, but it's continuing to grow. So it's gonna get to the point where you essentially aren't paying for any insurance. Usually it stays at least 5% ahead. So if you have $1 million in cash value, you've got to have at least $1,050,000 worth of insurance until you're age 95, at least in most carriers, and then you don't have to have any insurance. So you can have $1 million of cash value, $1 million of death benefit, your cost of insurance, 0. For anyone that says that's not true, here's an example. That same policy in the annual cost summary, if you go all the way down here to age 95 to 96, right there you can see what? The cost of insurance drops to 0. So.
Oh, here, by the way, after you paid extra on this all these years and you die, they only pay the face value. So it's like a savings account with a crummy rate of return.
They get locked up.
That when you die, they keep your money.
Yeah, it does technically pay both, actually. It's just that you're paying for less insurance as your cash value grows again. So let's say you have $500,000 worth of insurance and 0 cash value. Well, you're paying for $500,000. So if you die, your heirs get 500,000. Well, now your cash value grows, you have 200,000 worth of insurance. Your death benefit's still 500,000. Well, technically you have 200,000 of cash value and 300,000 of insurance, summing to equal 500,000. They technically do get both. It depends how you want to word it. You could also say, nope, they only do get that, but your cash value is considered part of the death benefit. Either way, that's a good thing. You want that to be the case so that your fees aren't through the roof and you get a policy that ends up looking like what they're describing. At the end of the day, a lot of the things they said can be true about policies if they're structured incorrectly and funded improperly and used for those goals. But if they are structured to the point where you have the least amount of insurance for the most amount of cash value and you let that grow, you simply just aren't going to run into these problems. These things are pretty commonly known now in the financial space. Dave Ramsey gives great advice to tons of people. I personally was interviewing for his company at one point, was in the interview process, ended up taking another role before I ended up finishing that. I think he's done tons of good. He's Christian, so I like that. I'm obviously Catholic. But yeah, I mean, probably record numbers of millionaires that he has made, helped tons of people. But in terms of Index Universal Life, unfortunately, I do disagree pretty heavily and think that they do spread some misinformation, unfortunately. But people have different opinions in the financial space. I am sure I'll review some of his future videos in the future on my channel and other people as well. If this was helpful, leave a comment below and make sure to subscribe.